Okay. Perfect. I've got the thumbs up. I trust everyone's enjoyed their morning tea. Today, I'm going to probably talk about something that probably maybe challenge the status quo around how you probably look at income protection. So I'm sure everyone's fully aware of the more recent changes that have taken place with respect to the APRA intervention regarding income protection. In particular, APRA was obviously concerned with the fact that income protection was hemorrhaging, and for good reason. I think over the years, as I'm sure you'd appreciate, every competitor tried to outdo each other. Benefit out of benefit, people would sit down in those rooms. I've been in those meetings, and you look at a competitor's particular wording and say, well, how can we outdo that? How can we get a better rating from the rating houses? Unfortunately, something had to give. So over time, with income protection, what we saw was your average duration for an income protection claim went from maybe 10 or so years ago, 6 or 7 months, through well over a year. So while incident rates increased as well, the more telling point and the reason there were significant losses was the duration on those particular claims. So in turn, as most of you in the room would be aware, no more agreed value, no more ancillary benefits as such, and other issues that were raised by APRA. Fingers crossed they don't reintroduce or push through those 5-year contract terms. I feel that's going to be a nightmare. They have deferred twice. Fingers crossed they've given up, but watch this space. Now, one other area that APRA also concentrated on was longer benefit periods. And this is particularly because they were concerned about the durations associated with these particular longer benefit periods and the lack of controls with respect to how are those claims going to discontinue or be better managed over time. So the main one, of course, that they advocated for was a change in definition after 2 years. So from own to any off definition. So of course, there's far more restrictions today. But fundamentally, for most individuals, for those that are totally disabled, and the overwhelming majority of claims, if they're serious enough and they have to run the term, they're going to run the term of those ones. But most of them don't do that. And this is where, and we've been listening to a lot of your peers in this space. And the question we've probably looked at is age 65 always the go-to? Now, we're not advocating one way or another. There's a good reason that age 65 actually exists. And of course, the main one is peace of mind, right? People get cover. If something were to arise and it's more serious, you've got that peace of mind around age 65. But what we've been listening to from some of your peers is that maybe a short benefit period may also be worth considering. And today we're going to walk through some of the reasons or maybe some of the pros and cons between both the age 65 approach as well as maybe a shorter benefit period and the benefits of going down that particular road. Now, out of curiosity, from a show of hands, with respect to the changes that have happened more recently, has anyone in the room been considering some of these shorter benefit periods? So this is going to be a hard audience. So it looks like it's going to maybe take a little bit of time to maybe win you over. I'm not advocating for one over the other. But what I'm going to do is I'm going to walk through maybe some of the benefits where it may be worthy of consideration for some of your clients. So we're going to work through some of the compliance concerns as well that many of you would have from a best interest point of view if you so happen to actually advocate for a shorter benefit period. And we're going to give you some tools that our techie team have built to help with some of these particular calculations and look at those particular benefits. So as Bob spoke about earlier this morning, we're not in a great situation at the moment with respect to cost of living. So we know where inflation's heading. We know that the cash rate is factored in to actually increase. We only had to we keep having to update this slide. So it's currently 2.6. We'll have a look in it when they meet next. So we know that people, including your clients, they're feeling the pinch. And from an income protection point of view, I'm sure some pricing stability would go a long way. People, how many times have you taken a phone call from a client? They've received their renewal notice and they're barking down the phone. It's a concern. It's a concern. We're well aware of it. So again, age 65, longer benefit periods are the default for most in this room, obviously, and for good reason. As we mentioned, there's peace of mind associated with that. But at what cost? And that's the concern that we've got. We've seen way too many people lapse their policies. They can't afford it. Age 65, benefits, especially in the legacy world, with all the bells and whistles associated with it. Agreed value, 3-tier total disability definitions, where you could work for up to 10 hours and have no impact on the actual benefit. You're still actually receiving that. So all of those things combined, obviously something's going to happen, and hence why we've seen such significant increases. So the first thing I wanted to position here with respect to shorter benefit periods is, are people aware? Well, they probably are now, it's in red. 90% of those claims or claims that are lodged industry-wide run for 2 years. In other words, they return to work within the first 2 years. So in that context, what you've got is you've got the overwhelming majority of claims. The shorter benefit period would cover it off. Now, I'm well and truly aware you're concerned about the other 10%, and for good reason. And we will talk to that. Did that figure surprise anyone? Did they assume it'd be higher, lower? I did mention earlier, durations had blown out, so that would seem to contradict that. Got a question over here.
When I have these discussions with my clients and have in the past, they don't want to be the one that, because there are examples, and I had seen the stats and I'm talking about the stats, but yeah, they don't want to risk being the one.
Totally get that.
And sorry, the difference between, because I've actually seen them have clients have their 2 years paid out, but still not make a CP claim. And that's been the big risk. There's a gap between getting those sick covered. So
that's great point, and we'll come to that. We will explore that. Just another question over here. That 90% actually is claims are finalised, so it would be inclusive even of those that have actually returned to work. So what we've extracted that, I think it's from APRA data, but I can double check that about partial. Thank you. So some of you may also be wondering, well, I mentioned about durations, getting longer. The problem is those 90% of claims, those simple claims where maybe someone had a knee arthroscopy or whatnot, have returned to work. But what happens is the outliers, the 10%, they have that accumulative effect, and therefore that's where insurers have been hemorrhaging. So they start to grow. So the open book of outstanding claims become greater and greater than, of course, that 10%. And that's the context we need to look at. So I might just stop right there. In view of this, one of the things that we've been looking at regarding short benefit periods is AIA. Some of you may be aware, in mid-August, we went to the market and said, for shorter benefit periods, 2 years and 5-year benefit periods, we will offer a 5-year premium guarantee. 5 years. That's pretty good. we had a level of confidence. We got the pricing team over the line in this particular space. And the reason for that is the argument was it is a more sustainable proposition. Therefore, we've actually added that guarantee, that rate guarantee. We've also added it to, that's inclusive of any indexation. It's inclusive of additional riders such as the superannuation, which we call the retirement optimizer. Is that right, Alex? Thank you. What I got right. And claims escalation. So all of that inclusive over the 5 years, you have a premium guaranteed in that space. It's pretty good. The other thing that's, I feel, a really viable proposition in that space is with our 5-year benefit, unlike age 65 benefits that change definitions after 2 years to an any off definition, with AIA, you will be getting a 5-year own OC definition and a true own OC. So there may be some that may offer 5-year own, but if the client's 60 years of age and above, there's a reduction in the benefit. So this is a true 5-year own OC benefit. So let's maybe have a look at the premiums. What have we got here? Let's have a look at a male, 65 years of age versus a 5-year benefit period. That's for a 40-year-old, 200K salary, white collar, we're looking at a 55% difference. So that's a significant saving. For a female, the saving is even greater. So we're looking at over 60% in that space. And that is inclusive of what I mentioned, the premium guarantee, the 5-year premium guarantee. So there are some significant savings that one can actually garner from this. With TPD, and we will talk to the strategy around shorter benefit periods with the pop-up of TPD, where there's also a risk factor that I'm sure most of you in this room are concerned about, the outliers. In other words, the 10%. You don't want to be the advisor, you sold a policy to the 10%. So we'll talk to that with TPD and what risks and what pros and cons are associated with that. So where can some of these monies go? Maybe a 40-year-old likely to have some mortgage debt, potentially a further investment property. In this particular case, some of the savings that one could actually look at. So we've actually pulled off here in this regard, just online, ING, an $800,000 principal loan over 20 years at a rate of 4% per annum. If I go down, if we think of the 200,000 individual, we'd be looking at a 47% tax rate. Even an extra $2,500 in extra repayments per annum over the life of the loan, we're looking at $46,000 in savings. Our techie team has built quite a few calculators there to actually assist you with some of this, and we will walk through some of those slides as well. So as you can see, you're sacrificing that 65 benefit period for a shorter benefit period and redirecting them, in this particular case, onto one's loan. What about someone who's a bit older, 50 years of age? Same scenario, we'll say, 200K, white collar, 30-day wait. Again, we're still looking at over 50% savings in one's premium. I have to admit, I was a little bit surprised with this one, because my feeling was as they get that little bit older, that gap would narrow, and it would after maybe 52, 53, because obviously we're getting closer to that 65. But if you have a look at that, there's some significant savings to be garnered there. And of course, they're closer to that particular age 65. Now, in this particular situation, it's likely maybe that 50-year-old may very well have made inroads into that level of debt. And what would be the natural, with the savings, where would be the natural place for them to actually redirect those funds? We've built a super projection calculator. In this particular case, this can be Googled, or you can find it on our website. And essentially what we're looking at here is, those additional repayments net, in this case 3,200 annual premium savings, are redirected into one super. If you are exceeding the cap, that can also go into the spouse's super. But what we've projected here, based on a 7% rate of return per annum, is 90K in today's dollars. So we're factoring in CPI, but overall 140K. So I can speak to this to a degree. Smarter people than me have put this calculator together. So, but take your time. You can muck around with it. Well, and again, it's available on our page or online through Google. Here's a bit of a matrix that may help some of you, and obviously with your clients. So again, just lining it up, age 65 versus 5 years. Like I said, 65, there's nothing wrong with that. Gives you more peace of mind. If they can afford it as well, and they've got the cash flow, go for it. We're not shying away from it. So for example, X-Plan, you have a look, we've got our top quartile rated age 65 flat 70 policy. So we're proud of that particular offer. So we just feel that there needs to be a bit more choice in that space. So what are you getting? So the trade-offs, there's the peace of mind regarding age 65. But of course, there's less disposable income for some. And of course, there's a change in definition to 2 years. So that may be a concern for some individuals. For the 5 year, what are you getting? You are getting a shorter benefit period, and there is a certain risk factor associated with that. That 3.6% that you've seen pop up again. Bear with me, we'll talk to that 3.6%. But of course, opportunities, like I mentioned, to put it into one's mortgage or into their super. They also, as I mentioned, they get the benefit of a 5 year own op definition, and of course the premium guarantee that I mentioned. Now that may be appealing for some. It may be appealing for some, but on the flip side, you may need to look at TPD or possibly trauma, or what we call an AIA crisis, as an extra line of defence. I know many in the room are probably thinking about the compliance concerns. So we look at Spassia Standard 5, and you notice we're putting bold print. Is age 65 best interests every single time? It may not always be, because obviously the costs associated with maintaining that insurance, the amount of times, and I'm not just talking about income protection here, the amount of times I've seen people lapse, for example, their trauma insurance, obviously it gets far more expensive. In saying that, I think it's 3 to 4 times more likely for one to actually claim under trauma than it is for TPD. But the problem is, obviously, as they get over 50 years of age, it's hard. It gets expensive. And the same could be said for an age 65 benefit. So the balance here is, from a best interest point of view, peace of mind, age 65, but at what cost? Can they maintain that in the medium to long term? And of course, standard 6, you need to take into account those broad effects. Now, if anyone's got any pen handy or anything, I'd probably suggest, if it concerns you, actually write down this case number, readily available online. This is the case number which we actually were able to look at. Had a good look at it. This is last year. And what it was about, it was probably about the concern that many are thinking about when advocating for a shorter benefit period. And in this particular case, the individual argued that the advisor did not act in their best interest because they did not offer them a longer benefit period. Now, there's certain nuances in this particular case. They were in an occupation they could get age 65, but they could get up to 5 or 6 years with another provider. But the overall ruling, we feel, is really relevant, because what it says is the argument was they should have been given age 65. They would have been better off. So after 2 years, the client was still disabled. That's the concern. This is not, however, always the case, because in this case, through diligent notes that the advisor put in their SOA, they were aware that the client had cash flow issues. In particular, the client was looking at a home build construction in the very near future, and they were aware that they were balking at the idea of taking out income protection simply because it was a concern. They were up for a fair bit of mortgage debt. And they made that clear. So in this case, just reading it out, the age 65 benefit would have impacted on Mr. A's cash flow, competing with his objective of maintaining cash flow to support the anticipated home build. While there would be no benefit to Mr. A, while there would be benefit in him having age 65, the advisor needed to consider this in the context of his overall objectives and priorities. And they ruled against him on that basis because the advice given was balanced. I think that's a really important case to keep in mind. Obviously, it's a lot more pages than that, but may very well be worth having a look. So it's that analogy. You know, there's risk advice. I'm assuming there's maybe most of you in the room are holistic advisors, and there's certain risks associated with investment advice. And we're going to walk through this same scenario analogy when it actually comes to talking about risk advice as well. So shorter benefit periods, what's the trade-off? So what we've been exploring is maybe adding TPD, or I also mentioned trauma, but more of the focus today is on TPD, because the way I see it, we're talking about disability. Trauma potentially could mean long-term disability, or it could mean someone going back to work the next day after getting maybe an early stage melanoma removed and still having that particular payment. It's not associated with time off work as such. But when we're looking at IP and TPD, there is a certain similarity. Both relate to one's inability to work. Income protection for both short terms and longer terms, especially if it's age 65. TPD, obviously ones that are more permanent in nature. But we feel there's certain synergies to actually explore. But still risks prevail. You're sick of this 3.6%? Yeah, I'll talk to it. I'll get round to it. So this is based on AIA's claims experience and some back testing, significant back testing. I might throw this one out there. Are people aware? So this is APRA data from it's 12 months old. Out of 1,000 claims, out of 1,000 policy holders at any given time, this is industry data, 12 will lodge a claim in any given year, 1.2%. Now, obviously, there's different variables. Someone might be in a blue-collar occupation, someone may be older, health, but overall, the risk factor of a policy holder, such as any one of yours, lodging a claim in any given year is 1.2%. That's based on tens of thousands of claims that there's been analysis on. So keep that one in mind just for a moment. Remember that 3.6% flashing a few times? This is probably the slide that's going to probably give you maybe some insight. So what we asked the AIA claims team to do, we asked them to look at the open book of claims, and they've got a couple of thousand. Pretty big organisation, obviously many policy holders. And we asked them to look at what percentage of claims, now these are predominantly or nearly all claims pre the APRA changes, of course. So with these particular policies, these are policies where they've had the more generous definitions, they've had agreed value, they've had other ancillary benefits, more generous definitions of total disability. So of those 1,000 claimants that lodged the claim 5 years ago, we found that 88% had well and truly returned to work within 5 years. Now you might remember I showed 90% broader industry data within 2 years, and I think there'll be some other providers out there that have used numbers like 94% after 5 years. At AIA, our return to work rate hasn't been as great. I would partially attribute that to the fact that AIA's age demographic is usually a little bit older. So over 40 years of age. That may factor into it to a degree. But overall, I think you get the general gist. Overwhelming majority of claims are finalised within a particular period and will be covered off by the shorter benefit periods. That leaves us, in the case of AIA, with 120 claims out of the 1,000, 12%. So what do we do next? We asked the claims department to have a look at these particular 5-year claims to tell us, are they TPD? And we actually asked overwhelmingly the assessors that were familiar with these long-term claims. So the notes are on file, the medical reports are on file. And we found that, I should add, because I had a look at some of these cases myself, 70% were considered categorically TPD. And that's been very conservative. We erred on the conservative side here. So that left us with only 36 out of the starting 1,000. In other words, 3.6% of clients we found that lodged a claim 5 years ago were on claim for 5 years and were not considered TPD. Of those remaining 3.6% or 36 clients, about half of them were long-term partial claims, which probably makes a bit of sense. I trust anyway. I might just pause there. Does that make sense? The 3.6%. And I'm happy to be challenged on any aspect of it. Are there any questions or concerns around how we've arrived at that? Okay. And I had one other thing. AIA, that's AIA data, 3.6%. We feel that this further cements this point. So KPMG and FSC undertook a joint report in 2020. I think it's somewhere in the vicinity of 83,000 claims that they actually looked at. And what they did, and this is provided to actuaries across all insurers, and the finding was that if one was on claim for 5 years, the chances of that individual being on claim 12 months later was 95%. Now, they didn't assess whether they were TPD, because these were purely income protection claims. But what I feel it tells you is the probability of a return to work after 5 years, particularly for those individuals that are totally disabled, is quite low. There may be some other figures that are floating around industry-wide. I think I alluded to this a little bit earlier. There may be some other insurers that after 5 years have a 94% success rate, which brings the risk factor right down to 6%. But even if I was to play the devil's advocate on those remaining claims and flipped it on its head and said only a minority were considered TPD, notwithstanding my own personal belief and the back testing that we undertook, that's further coupled by the KPMG report, even if we flip this on its head, we're still looking at a 3 to 4.5% worst case scenario risk factor. For some in this room, it may be tolerable, maybe worth considering a short benefit period, maybe with looking at TPD. For some, it may still not be good enough. And that's probably a risk that you probably need to weigh up. But I feel that that data probably gives you a little bit more insight in that space. The only thing I probably would add here, and I have had a lot of claims background here, when you factor in that 3.6%, every last one of those claims that we looked at were based on the old world of income protection. And that would have meant green value for the majority. It would have meant maybe in some cases, generous total disability definitions, such as 3 tiers, which I alluded to earlier, where someone could still be working up to 10 hours and still receive the full benefit or just have a reduction in income. So obviously the controls are tighter now. So are those individuals going to be on claim for as long in the future? The probability factor I would put to you is probably lower. It's probably at around 2.5%. And circling back, that's not factoring in the clients that didn't lodge a claim. Do you remember that figure I said, 1.2%? Or sorry, yeah, it was 12 out of 1,000. That particular figure should also be kept in the back of one's mind. So our strategy around TPD and the costs associated with that. So remember, you're making some savings in that space. Let's have a look at this. Remember that individual, again, 200K salary. They can get 70% of that covered under income protection. So that's 140,000. But that's obviously taxable, right? So I'm assuming most people may be looking at income protection outside of the super environment for good reason, more often than not, obviously the tax benefits associated with that. But in turn, you know, when you consider the taxable component, they're going to be getting to age 65, about 100,000 after tax. Sound fair? Okay. Now, let's have a look at how one could maybe structure this a different way. So let's assume a TPD amount, and we'll come to an amount and we'll walk through that as well. We've got a calculator. Let's assume a TPD amount. In this case, we've landed on around $2 million. And I probably wanted to just anchor to that for a moment. $2 million worth of life in TPD based on someone, say, having a $700,000 loan. In that particular case, we're looking at the TPD of $2 million, clearing the debt, and $1.3 million left over. This is based on, again, that individual who was a 42-year-old, being on claim for 5 years. So at the end of that 5 years, they're 47. Got a question over here.
Are we talking own occupation TPD?
We were, with respect to the premiums, or you can select both.
Your own figures show that most of those people that would have been assessed to have met TPD
would meet an own occupation definition. That's a great question, and I welcome it. So there's a really good reason why we assessed on own occupation. We asked the claims team to actually tell us whether or not those individuals who've been on claim for 5 years under income protection, what have they been assessed on for their income protection claim? Own occ. They have no line of sight around whether or not that client has any transferable skills. In saying that, I put it to you, and I'm sure most of the people in the room would agree, obviously the overwhelming majority of claims are perfectly genuine. And the overwhelming majority of individuals, if they have capacity to retrain or return to some other form of work, they've well and truly returned to work well before that 5 years. In fact, within that 2 years that you mentioned. So in that particular case, the outliers that are on claim for 5 years, if I don't have that assessment, I would put it to you that the overwhelming majority would also be disabled on the any OC definition. And the reason I say that as well is there's also further data that's been floating around out there that actually suggests that the acceptance rate on any versus own, based on APRA figures that I think they're provided every 6 months and they release them, I think acceptance rates on retail TPD is about 86%. You don't find a great deal of difference between own and any. That's the reality. So someone who's been on claim for 5 years, especially if they're totally disabled, I think they're going to be TPD, own already. But I welcome the question and I accept that that data we gave could only be under own for good reason. But I accept it. So remember what we said, $2 million. 700,000 to clear the loan, there's $1.3 million left over. In this particular case, if you have a look at it, if you lock it into an income stream with a 50-50 tax-free component, and there's a tax-free act, so there's an act there, which is over my head, sorry, my manager actually put that in, but assume maybe some of you might know what we're referring to, but if you want to maintain that same level of income, of say $100,000, The client's 47 years of age after 5 years of receiving that 5-year benefit period. They've got to, and they want to retire around 65, or they were planning on 65. If they want to maintain that same level of cover of 100,000, if they were to put that remaining 1.3 million, and we've got a calculator that might help with that, we're actually looking at 100,000 net benefit. So 50% is tax-free component. The remaining 50,000, although it actually is taxable at nearly 7,500, it's reduced to zero by the 15% pension tax offset. I was actually speaking to my manager who was trying to explain it to me. So hopefully it makes sense to some of you people, because I struggled with some of it. But what we're effectively saying is for those remaining 18 years, we want to keep the client in that same position. And that's what we're hoping to achieve with that particular amount. Now, what I didn't factor in as well is, in this particular case, the client may have super through their employer, as an example. So that 2 million I was referring to was based on the fact that starting at ground zero, they didn't have any cover whatsoever. If they've got other cover, that amount can be less. If they've got less debt, then of course that amount again can be less. We're just painting, if you like, that high scenario in this particular instance. So that's the amount that we're talking about. Around 1.3 million, based on a 7% rate of return. We've got this again on our website that helps with the calculation. And as I referenced, the client went on claim at 42 years of age, they're getting their benefit of 140K, but after tax 100K. You've got 18 years to run, that's the amount we calculate at. Let's have a look at this. What do the premiums look like? Okay. Year one, male, 700,000 life and TPD. This is with age 65. So they've got the peace of mind of age 65. These are the net amounts. We've deliberately factored in that, obviously, the tax deductibility if it was under income protection. Sorry, outside super. Super owned life and TPD, 700K. That's the debt. That's the amount. Let's have a look at it down here. 2 million. So nearly 3 times the sum insured. Pretty much around the same amount of money. Now, there is a female component. You'll notice with the female, because income protection is more expensive, the savings are far more significant. Have a look at that. That's still getting nearly 3 times more TPD. Now, I'm going to say something else here. Clients 47 years of age after the 5 years is expired. If they had age 65 and an inadequate level of TPD because of the peace of mind of taking out age 65, what might happen between 47 years of age and 65 years of age? Someone's been on claim for 5 years. Have they got health issues? Significant component would. In fact, I'll tell you, one of the top 3 causes of claim for income protection is cancer. Unfortunately, some of those individuals are going to have a poorer mortality outlook than an individual who has never claimed. That shouldn't surprise anyone. So factor that in. We also obviously spoke about the fact that there's a tax benefits associated with taking a lump sum at 47 years of age versus constantly having to pay tax at that particular rate right through to 65 years of age. So think about that as well. There's also something else. Not every single person who's paid out a TPD benefit is going to be off work forever. Some of them might end up retraining. Some of them may return to work part-time. In other words, they may come back to the market and have no further income protection benefit or a reduced income protection benefit. So just factor all of that in. When the in contrast, when the TPD claim is paid, If they go back to work next week, as unlikely as that might be, if they go back to work next week, no one's knocking on their door asking for that money back. That's an important point. It's also how many, I think there's some in this room that have experienced long-term income protection claims. How much do clients enjoy going back to the doctor to complete the forms every month or so? Don't have to think about that once the lump sum's been paid. One final thing, because I know I'm conscious of time, because we started a little bit late. We've got here the different ages. Remember, we started at that 2 million or so, based on 700,000 debt and how much they needed. But it's not a set and forget strategy. And what I mean by that is this strategy is based on how many years to retirement and level of debt. So after say 3 or 4 years, they may have reduced the level of debt. It's no longer 700,000. Their years to retirement is less. So do they need that particular amount still? We're all conscious of the fact that when someone gets over 50 years of age, the premiums tend to go up. Not a little bit, a fair bit. This will help with retention as an option for those clients that might be feeling the pinch. So less years to retirement, reduction in debt, in turn, look at this, you can reduce that level of cover. Some food for thought. I've said it was meant to be balanced. I'm talking about short benefit periods a lot. There's no right or wrong. Age 65 works very well and has serviced many people over the years, and for good reason, as I mentioned. This is maybe just planting the seed and walking through that additional option and strategizing for that. So hence why we've been pretty strong advocates on that 5-year premium guarantee. So we've built together that whole matrix that is available to everyone. We've got those other tools online that are available to everyone. Play around with them. Feel free to pick up the phone or email. My details are available, and we can talk through some of that. So without further ado, I'm pretty much done. But if anyone's got any questions on any of that, was it a lot of probably calculations maybe the people probably want to walk through, but I'm just wondering whether or not it maybe swayed the mind for some clients. So just throwing it out there. So any final questions, anyone?
John, question from the Zoom audience. How many of the 2-year policy claims relapse and for how long? Was asked earlier.
2-year claim, 2 short benefit periods relapse. So in the case of a claim relapsing, so for example, with the current income protection, and again, it may differ from company, but generally speaking, we have a recurrence within 12 months. So if a client were to return to work for greater than 12 months, if they have a recurrence of that same condition, the period would actually reset. So they get another full 2 years. So what percentage? I'd be lying to you if I knew. There may be some, but as I mentioned, if that particular client has returned to work for a set period, they can restart that claim. We'd have to reset the waiver period, and it will be viewed as a new claim.
There's another question here. What are the income offsets that AIA would use the benefit paid in an own occupation situation?
Own occupation. I take from that, I'm assuming income protection though. So generally speaking, with the IP core offering, we offset sick leave, pretty much like every provider. We won't offset accrued sick leave, and we won't offset annual leave or long service leave. So if one takes sick leave, we'll be offsetting that. There's also, depending on the setup, if they're self-employed and there's some ongoing business income, but after they're going on claim, that is also a consideration that needs to be factored in, both at claim stage, but also the underwriters often would look at whether or not the condition, sorry, the business, the way it's set up, would actually result in still a significant ongoing income trail. So that would be another thing that we would offset. Workers' comp and other benefits as well. Anything else there, Anita, on Zoom? All good. Guys, I'll be around at lunchtime. If anyone's got any further questions, feel very free.